Dear friends, a very warm welcome to all of you. The topic that I have brought for you today relates to ratios analysis. As you may be aware, ratios analysis is a broad topic and in which there are many ratios that we are calculating for the business. Today we'll be discussing at specifically two types of ratios. One is trade receivable turnover, also known as debtor collection period. Now these and another topic is trade payable turnover, also known as creditor collection period. Now we'll be looking at the two in sequence. These two ratios are specifically being added in the O levels CAIE examination syllabus, and that weren't previously part of the syllabus, but they are now added. So let's discuss about trade receivable turnover. First of all, we need to learn how to calculate this, and after that we'll study about its implications, that what does this ratio means. Trade receivable turnover is calculated as formula is trade receivables, also known as account receivables. Previously it was also known as debtors. Then we have divided by credit sales. Credit sales or revenue means the same thing, but we'll be working in credit sales only, not the cash sales. Then multiply by 365, because in an year there are normally 365 days. Now, this is a formula which you need to remember. This won't be given in the examination question. Trade receivables upon credit sales into 365. Now, let us suppose in a statement of financial position, that is balance sheet, we are being given the debtors trade receivables at the end of the year, that is $40,000. Means our customers owe us $40,000 and our credit sales is, for example, $500,000, which is already given in an income statement. If we divide these two and if we multiply by 365, the answer that I'm getting on the calculator is 29.2. Basically, this ratio is calculated in days. So this is basically 29.2 days. Now, rather than writing the answer as 29.2, what I'll be doing, I'm rounding it off to the whole number. For example, instead of 29.2, I'll be writing 30 days. Now, why 30 days? Because the maths rule says that if there is 1.5, you round it to 2. But if it is 1.4, you round it to 1. But in this case, instead of rounding off at 29 days, I am rounding off as 30 days. Why is that so? I am breaking the maths rule here. Why? Because my dear students, in any of the receivable or payable or in any days ratio, whenever we are working in days, okay, we'll be always using this technique, whether it is 1.1 or whether it is 1.9, we will always be round off to 2 days, okay. Why? Because 29.2 days means we have already entered in 30th day. Now let me explain you with the help of an example. For example, you have your birthday on, for example, 15th of March. Now at 14th of March, as soon as the clock shows 12 a.m., you start receiving messages from your friends and your relatives, that happy birthday messages. Now you must think that today is 14th of April. Why they are wishing you the birthday? Because you have the birthday on 15th of March. The reason for that is the clock is already showing 15th of March, because at 12 a.m. at midnight the date has already changed. Okay, so whenever in this scenario, whenever in a day scenario there is 1.1 day or 1.9 days, you will always round off to 2 days. Okay, so now what does this trade receivable turnover means? Trade receivable turnover, my dear friends, means that our customers will pay us this amount in on average 30 days. Means our customers on average take 30 days to clear their debts. So the question here arises that whether the ratio should be less, is it less the better or more the better? The question here arises. Now the answer to this question would be, now there are two aspects to look upon. One is liquidity of the business and another one is profitability of the business. And because this trade receivable turnover and trade payable turnover, they are both part of the liquidity of the business. So firstly we'll be looking at the liquidity portion. So what does the liquidity means? Liquidity means that how much cash do the business have to pay for its current liabilities, or how much current assets do have to cover for current liabilities, or how much bank balance do we have. This means liquidity. If the receivable turnover is less, this is normally good as far as liquidity is concerned, because the more the customers time take to pay our debts, the more we have liquidity problems. Okay, if the customers pays us slowly, this means this would hamper our liquidity and we do not have enough funds to operate the business effectively. Secondly, the more the customer is taking time, the more there are chances for bad debts. Okay, so therefore we want our customers to pay as early as possible if the liquidity is concerned only. But the problem here arises that if we ask our credit customers to pay very quick, to pay very prompt, there are two problems. Firstly, we need to give them cash discount known as discount allowed, because it is an expense for the business. If we are giving very much high percentage of discount to our customers, this means our profitability will hamper. Okay, so this is not good for profitability perspective, that customers, we do ask from our customers very early. And secondly, there is a problem is that if the customers pay us very early, then the customer would not be very happy. Why? Because initially we committed our customer that we will give you 30 days credit. Okay, we allowed the customers, we stated a policy that we will be giving you 30 days of credit. But now if we started calling our customers just after a week that when you will be giving us the money, and we are sending our recovery agents to that customer, so this customer will be annoyed. The customer will say that this party or this supplier is not good, so we'll be switch our business from us to some other supplier. Okay, so to some our competitor. So this is not good for the business, because our sales will be lost and our customers will be lost. So therefore it will hamper our profitability. Okay, so the question here arises, what is better, the less it would be better or more it would be better? The answer to this is, my dear students, we need to see what is our policy, how much credit do we grant to our customers. If we have already stated a policy of 30 days, receivable turnover should be near to somewhere about 25 to 35 days is good. Okay, because the stated policy is 30 days. If the stated policy is 30 and the customer is taking 60 days to pay, this is not good. Okay, this is clearly not good. This will affect our liquidity and we'll be suffering many problems due to bad debt and all this. And if the customers are paying us within 5 days, but we are allowing them credit of 30 days, this is also not good, because the customers will be annoyed and they will run after they will be poached by some other suppliers. Okay, so this is basically trade receivable turnover. Then similarly we can study about trade payable turnover, also known as creditor payment period. This means how much time on average we take to pay our suppliers. Okay, how much time do we take to pay our credit suppliers? So the formula would be, instead of trade receivable we'll be writing trade payables. Then instead of credit sales, we'll be writing credit purchase. You must remember, only credit sale and credit purchase will come in these ratios. If we have given total sales or total purchase, we will be deduct the cash sale or cash portion from it in order to arrive at credit sale or credit purchase only. Then again multiply by 365, because there are 365 days in a year. For example, in an examination question, in a statement of financial position balance sheet, in current liability we are given trade payables, that is 25,000. Credit purchase is already given in the question. In an income statement, that is 300,000. But if the credit purchase is not given and the cost of sales is given, we can reverse work the opening and closing inventory in order to find this purchases figure. Mostly it is given in the question. Multiply by 365. If I solve for this, the answer that I am getting in my calculator is 30.42 days. Now instead of writing 30.42 days, I'll be rounding it up to 31 days. Because if I was doing a math question, in the math question this 30.42 in round off become 30 days. Okay, because it is less than 5. So, but in a receivable and payable turnover, or maybe inventory turnover as well, if we are working on days, we'll always be rounding up. Okay, instead of 30.4 days, I have reached the 31st day to pay my suppliers. even if there are few minutes and few hours, but the still date has been changed. So 31 days, my dear friends, means that we are taking on average 31 days to pay our debts to our creditors. Okay, we are paying our creditors on average in 31 days. Means to some of the creditors we are paying early, and to some of the creditors we are paying late, but on average our payment period is 31 days. Now the question here arises, dear friends, whether 31 days is a good time or a bad time. We can say this by comparing the policy of the business. If we are just thinking of the liquidity, payable turnover should be as more as possible. If we are thinking about the liquidity, receivable turnover should be as less as possible, because we want our customers to pay us as earlier as possible, as earliest as possible. But if we are talking about trade payable turnover, we want to take extended period of credit from our suppliers. Why? Because beta supplier money, the money that we are getting from suppliers, is a free source of finance. So instead of taking money from the bank, instead of arranging loan from the bank or overdraft from the bank and paying bank interest, we would prefer that how much suppliers can be extended and how much we can juice out from the suppliers, we will try to juice out from the suppliers. So therefore trade payable turnover as far as liquidity is concerned should be as more as possible. But again the problem here arises, if the suppliers have granted us, for example, 10 days of credit and we are paying our suppliers in 31 days. So this is not good for the business. Why? Because our suppliers will be very annoyed, they will be very dissatisfied, they will be very disappointed by the business, and there will be two things. Firstly, they will stop or they will refuse to supply further goods to our business, or secondly, if they supply to us, they will ask for cash payment, or instead if they are allowing us credit as well, they will be charging very high prices to the business, because they know that this customer is not good, they cannot be relied upon, they take a very long time to pay our debts, therefore they will be charging us high prices than to our competitors. If they are charging high prices, then our cost will be higher as well, and if our cost will be higher, so therefore our profit will go down. So as far as profitability is concerned, payable turnover should be less, because there are two things. One is we do not want to wish to pay high prices for our goods. Secondly, if we pay our suppliers early, we will also be getting cash discount, that is discount received. And thirdly, we will be maintaining good relationship with our suppliers. Therefore, if the suppliers can trust us for the payment, therefore they will be a reliable source for delivery in the future. So I hope, my dear students, you will able to understand the concept behind trade receivable turnover and trade payable turnover.